Look, I got a sick family over here. Hey, good morning. Let me know if you can hear me. I'm kind of playing with two different computers at the same time so that I can see everything. That's what you see a Wendy Ariaga, that's my wife's computer's Zoom login. Are you with me?
Yeah.
Hello?
Hey, there you are.
Okay, yeah, sorry. I think the wrong speaker was on my side. So you can hear me okay, right?
I can hear you perfect. Yeah, for sure. My name is Jason Fabella. Welcome. I know you had posted some positions on Tesla in our Leaps option communication in Discord. And I just want to cover what you know and maybe what you don't know, and we can kind of work from there.
Yeah, if you want, I could just share my screen and maybe I can go through what I'm seeing and then where the questions are coming from, because that may actually be more helpful rather than just targeting random questions and you don't know why I'm thinking like that. So
actually, why don't we walk through some of your positions and I can start to talk to you about break even, because that's probably like, you understand like intrinsic value and extrinsic value. Okay,
yeah.
So you're good. No questions. Let's pull up your I'm gonna delete the ticker symbol. Sorry. I prefer to just talk about these in the map of them. So let's talk about your first strike price.
If you don't mind, can we start with the Google? Because I would love to understand shares versus Leaps, and then we can go into Leaps itself, right? Because I think that will be it'll be helpful for me to understand. So, because like from a flow perspective, I think that's going to be easier because I've traditionally done shares. So Google, I've been collecting for a while because I've worked for them, so I got the shares there. So let me check my cost basis.
Sure.
I think it's around 120, 130 from memory, but let me just check.
Sure.
Okay, so it's okay, so my current cost basis is 140.
140. Okay, that's still pretty amazing considering where Google's at today.
Yeah. So the thing is like when I'm looking at, so this is purely about premiums and stuff, right? So when I go into Google, I'm selling weekly covered calls on those shares. So I do basically sell to open, and then I have about 900 shares. So I can make 9 calls, right?
Right.
And I'm getting a premium. Say if I stick to like a 20 delta, I get a premium around $500 a week.
Why are you picking?
Which is fine.
Let me ask you a question. Why are you picking weekly?
Because monthly just doesn't give enough premium. So if I even click for, I don't know, next month, and I pick a 20 delta, I'm getting 1,000-ish. So it's just basically double. So I'm basically missing out on 2 weeks worth of premium, right, by doing monthly.
Okay, let me look. Let's look real quick.
I can show you on Charles Schwab. I'm on the account if that helps.
Yeah. Okay, so you're selling what for this week, the 28th?
Yeah. So I just do weekly.
What's your strike?
187.
Oh, nice. Is it 187.5?
Yeah. So that gives you an 18 delta, and that's 468. You
received $468 off that?
Yeah. Okay, but if you do monthly, so if I do like March 21st,
right,
the strike would be 195, right? So it's around the same delta, 0.17, 0.18, and you get 1,080. So yes, you do get twice, but if you think about it, 468 times 4, right, is double 180. And Google's fairly safe, right?
It's just the difference here. You're just selling more extrinsic value.
Right.
But with shares, the crazy thing about shares versus leaps is, I mean, you could considerably sell extrinsic value in perpetuity, right? These shares are yours, and there's
Yeah.
no expiration on them. So anything that you sell, you could roll. So I
Yeah.
completely agree with you. I think this is a phenomenal idea. Now, remember, you're receiving this for 100 share package, right? So
Yeah.
to find out how this lowers your cost basis, just always divide your premium price by 100, and this is going to give you a per share drop of
Yeah.
$4.68. So this means every time you do this, your cost basis here is subtracted by $4.68. And like, I don't know if the brokerages, any of them, I don't know if they track this information for you in this way.
Yeah. They don't.
Really,
Yeah.
they don't. The user of, their market
Right.
positions to understand exactly where you are. So after the first time you do it, you go down to 135, what, 32?
Yeah, and I've been doing this for a while with Google, so I like at least 6 months. So my cost basis is probably like 120. This is why I think the 120 number was in my head.
Yeah, okay. That's pretty reasonable. And I think moving forward, I think do you track it in this way?
I have an Excel, yeah, so I track
Okay,
all
perfect.
the
Yeah, yeah.
trades.
I
Yeah,
I also have an Excel. I don't keep shares anymore just because of the capital allocation. I
yeah,
just find it's more expensive to keep shares. But I mean, since you have these and since you kind of got them from an employment kind of perspective, man, I think that this is a phenomenal thing for you to keep forever. If you ever do, if Google does ever kind of like go on one of those runs like it did in January when it went from like 185 to 200, and
yeah,
and the strike gets passed, just roll it out into the future and be unconcerned with how far you have to roll because they're shares. I mean, like this is forever yours.
right. So I guess this was what brings you to the question, right? So this is the premiums I'm getting for keeping the shares. But if you think about it, if I sold the 900 shares, right, I would get around 150K. If I put that into Google Leaps, given they're at kind of a low now, which is around 180, 81, and then so what I would be able to do is actually buy 30 calls, right? 30, 33 calls. And then if you look at the weekly premium, even on a 20 delta, so if I go back to so call 187.5, same delta, but it'll be 30, right? So then I'm making 1,500. So I think I
Yeah,
was like, should I just swap to a leap?
I certainly understand what you're saying. Okay. Like this looks like it would be 162,000 in capital.
Yeah.
I certainly understand what you're saying. And there is certainly an argument for that, right? Like that you're absolutely right in capital allocation. Like you could completely divest out of Google. You could have the 162. You could put it in any leaps. I personally
Right.
wouldn't go back into Google Leaps. I also would really, I'm going to ask you some questions about, do you understand? Google pays a dividend.
Yeah.
So when you come up against your ex dividend date and you're selling a covered call on it, if you get assigned on that covered call, do you know who pays the dividend?
I think we do.
You do.
Yeah.
So if if I were to exit this position with
Mhm.
this capital, I would not put it back into a dividend paying company because that is a risk, right? And
Okay.
when you talk about you said you've done the math on this. You said you could do 30 leaps, right?
Right.
And that's times 100 shares. You're gonna have 3,000 shares. I mean, if you have to pay the dividend on 3,000 shares, that's going to be a big bill.
Right.
I don't know what Google's current, I think it's 50 cents a share. Let me see, $2 a share. I can't remember what it was. Dividend. 20 cents. So that comes out to about $6,000.
But you pay if you're assigned, right?
Yeah, if you're assigned. So if
Yeah.
you sell a covered call, and I mean, for my brokerage, Robinhood warns me if it's coming up, the ex-dividend date is coming up. It would only be like 1 week every 4 months that you'd have to skip, but you know, it is a
Usually,
possibility, you know.
Usually I don't do earning if it's earnings or dividend on any of the stocks. I just don't do calls or anything on that week. Only the other weeks I do it.
We'll talk about practice separately, because I hear that, right? But then like, look what happened Friday, right? I mean, Nvidia's earnings are coming up, and I've had a conversation with a couple of people, and they were like, oh, I don't want to sell covered calls because the earnings are coming. And I'm like, you know, those earnings don't mean anything to you. Like, they could be great, they could be horrible. Nvidia might move. That just means you just have to roll, right? I mean, if there's a sudden surge in the share price and you don't want to lose your position, you just roll it. And for leaps, the goal is to get to expiration with a lot of intrinsic value. So my preference is always to roll that kind of situation because you're trapping equity.
But sometimes rolling has caused me to have a debit. This is why I don't like to roll. I'd rather just exit. Because let's take in.
Are you rolling late? When do you roll?
So I from memory, I think the last one I had to like a couple of days before, but the price had already gone right in the money. So then I obviously just I rolled, and then like I think it was a week or 2 weeks out, and then it expired, and I think I lost like $2,000 or something to roll it.
Okay, let's talk about that because this is a good example. Let's say any share price, let's say today's share price is $120, and you go to sell a 140 covered call for that week because you do weekly. And then suddenly you wake up in the morning and the share price is at 150, right? Let's say it did it overnight, because that's usually when extreme share price movement happens. It happens outside of trading hours, of course. So now you say you have to roll for a debit. Now, what that means is you either didn't roll far enough or you're trying to roll too high into equity. And so for this example up here, let's say we were talking about these shares, right? And you had this drastic price movement. I mean, since these are on shares, I mean, you could technically roll out 6 months. You should never roll for a debit. The only time you should roll for a debit is if, say, you're in a leap and for some reason you sold below your strike on the leap and you have collateral at risk. Maybe that would be the only reason to like roll for a debit, to pay to get out of a bad trade. But the really like realistically, like, don't put yourself into a bad trade, right? Like that's planning and understanding to keep you out of that position. So
I guess the issue is like, I don't know the numbers off the top of my head, but let's take this Google example. If it means I need to roll for 1 week and I pay say 1,000, right? Then it's actually better I do that than roll out say 6 months and I pay 1,000, because here if I roll out by say 1 week and I pay 1,000, the next following 2 weeks I can make the 1,000 back, right, in the premium. Whereas if I lock it out for 6 months, I can't do anything for those 6 months. So this is what's happened with Archer. I put all my capital into Archer in April, and now I'm stuck, right? Because I can't do anything with that money. So yeah.
Do you have leaps on Archer?
No, I think this was just a put or something. But the thing is capital's stuck there, so I can't actually.
Oh, did Archer fall?
I think it's a put. No, I'm still making money off it, so I could exit, but like I won't get the full amount, right, that I put in. So this is kind of so it's the same with the rolling, right? Like the longer you roll, you're kind of. So this is actually what happened with Google and Nvidia. I rolled from January to February, and basically I couldn't make trades in that period of time, obviously because the option's still open, right? So I think it's just to avoid waiting too long to not collect any sort of premium.
Yeah, that's a great point. And I will tell you, if you're in the covered calls game, that will definitely happen. Are you
right?
And this is a semi-personal question. Are you living off the premium income?
No.
Okay. So I mean, like, and so like this is kind of a theoretical question now. Like, does it matter to you that you have to roll it then for a month or 2 months?
It does, because the thing is,
you don't see the growth, but like you are establishing equity in a position and you're receiving income every time. And for me, I'm in a similar boat that you are. I don't live off the income, and to me, it's more important to see the growth in my account and the growth in how the capital is utilized than it is that I see like I'm getting paid this week, I'm getting paid next week, I'm getting paid March 14th and 21st and 28th. Like I do understand that I have to move my positions around to win.
Yeah. I honestly I think it's more of a how bad is it, right? So for example, with Nvidia, I think I had a covered call for like 140. It went to 141 or something like that. And rolling out was like $200. So I was like, okay, just do it. Who cares? And anyway, it dropped. So then it expired this week and we were done. So I kind of just make a call because the $200 is like, okay, well, I can make this in premium next week. If it's thousands, I then don't do that, right? I just roll it out longer. So I think it's not a hard fixed approach. It's more like I look at the numbers and then I go, okay, well, how quickly can I make this premium versus like in Google's case, right? It's never going to jump like from 120 to 115 a day, like realistically, right? So I don't think we'd ever hit like paying $6,000 to roll it out for 1 week. Whereas Tesla, for example, we could probably get into that scenario. So
I think Google did do exactly that in January or December. It went from December 5th at 175 and then it jumped up to 195. And then I remember I bought Google at like 185. I bought a leap on Google at like 185 and then it hit 200 and I exited. And that was over the course of like 2 or 3 weeks. I mean, they can all do it. I mean, Tesla is probably the biggest culprit, but I mean, anybody really can smoke a covered call. And the only reason I say roll versus paying to get out of the trade like that is when you set up the trade initially, you got paid.
Yeah.
If you roll, you can decide the strike, you can decide the expiration, and you're looking at the numbers, you can decide if you're going to get paid or not. Personally speaking, I always prefer to get paid on these trades. I'm never putting more money in. So that's the only difference.
Right.
Why pay to get out of a trade that has technically this trade? I mean, when a covered call goes against you, this is super important to remember right here. When a covered call goes against you, it is still in your favor.
Yeah.
Right?
Yeah.
Because you own the underlying asset.
Right.
It would be the same thing as like a house that you're renting has gone up in value and you pay those renters to get out so you could rent it to somebody else. Why would you do that?
Right. Okay. That makes sense.
Just let them rent it for longer, man. But make them pay you again. Don't
okay,
don't
that
pay to
makes
get out of
sense.
covered
Yeah,
calls. Unless you're in like some kind of weird negative equity position, because like if the market pulled back like super strong and you know
right.
you were in a very aggressive covered call that was technically under your strike that you owned, then you're posting collateral on a trade, and
Yeah,
that certainly could be a recipe for disaster, and you may not have the extrinsic value to be able to push that trade into the future. Then maybe, right?
right.
Then maybe that makes sense. But yeah,
Um,
you brought up Tesla, and you have like an extraordinary
so
Tesla
before we go into
volume.
Tesla and Leaps, I'm just wondering, so on the shares versus Leaps, right? So what you're saying is, I guess, keep the shares. The reason I wanted to sell some Google is because we're taking up about 30% of my account. So I wanted to diversify. So maybe I don't sell everything, right? Maybe I go from say 900 to 500 shares and use that 400 shares to go buy Nvidia or some other Leap, right? So that's kind of where my brain was.
I hear that, and I certainly understand what you mean, but there's a difference between shares and leaps. And I see shares as like hard infrastructure
Yeah,
because it's a forever position, right? Like
yeah,
you you can you can play the selling covered calls game on it 52 weeks a year forever.
yeah,
The leaps expire, right? And you already have a pretty good grasp on where your cost basis is, and you see what you're doing to your cost basis every time you transact on it. I mean, like, this is a good
right.
position. I understand that it has I understand that it is holding some of the equity of your portfolio, but I mean, if you've been doing this transaction for a while, I mean, think of it in this way. I mean, Google is helping you build your portfolio.
Yeah.
That's creating cash flow to you, and cash flow is king. So
I guess it was more the premium, right? So say we round up to 500 a week. So that's
yeah,
$2,000 a month.
Google's not great premium, but again, like
Right.
it's forever. Like you own it already. You own it cheap. You own it cheap. You're into it for maybe 120. You were saying maybe less, but every week it continues to go down, and it's cash flowing. So it's
Right.
I mean, Michelle, it's tantamount to you owning that apartment building already, right? Like
Right. Right. Yeah.
now you have 900 units that you're renting out every 2 weeks. I mean, keep that. I mean, if it was me in my account and I was already in this position,
Yeah.
it would be hard for me to exit, such a strong position. But truly, you're
Right.
right. It is $162,000. Like you can do whatever you want with like how you spend your capital. But dude, that's a pretty good forever equation right there. This one right here, like that you're selling
Right.
on,
Right.
it's lowering.
Right.
I mean, you understand the cost goes to zero at some point, and your $162,000 have completely vacated that position, right?
Yeah.
It would still be
Yeah.
worth that, but you're also right that capital matters and how you use it matters. So having $160,000 in cash and executing it on new leaps where you're selling a couple calls on is also going to be more profitable, but there will be an associated expiration date with that transaction. So, two different things to consider for sure. This is you are in the long game right here with this, right? And you're
Yeah.
already in it.
Yeah.
You showed up in it, and and you have leaps. I mean, you're printing money. This is a good problem.
Okay. Yeah. I mean, it makes sense. Yeah. Maybe I'll keep it. I mean, the only stocks I own is Google and Nvidia. Everything else is Leaps or
I mean,
puts and whatever. So
those are two good ones to own.
yeah. They're safe. They're good. Those
Very
are
safe.
okay.
Very safe.
Um.
I mean, this is a
Okay.
very safe position.
Yeah. That's why I've kept those stocks. I was just curious on the stocks versus leaps because a lot of Henry's videos about accumulating dollar cost averaging stocks. Um, but there's nothing on Leaps. That's what, I guess kind of where my brain was at. Like,
I
and
mean,
obviously then I looked at the premiums, and then I was just
yeah.
comparing.
I mean,
So,
you can't even dollar cost average into this because like you could not
right,
sell a put to make any money to bring your cost basis down. Like you are literally bringing your cost basis down with every transaction. But I don't think you
right,
could. I mean, Google would have to go down to like 120, and then you sell
right,
puts there for you to make any money
right.
on the put side. So I mean, that is not for you right now with this. Position.
Actually, if I keep the shares, I can only sell covered calls on them, right? So I can't do spreads. I can't do puts. Is that correct?
No, that's not correct at all. You can sell covered calls on your shares, and
Yeah.
that is one position. You could do spreads. That's a completely different position. And dude, I just want to bring you to my little spreads chart up here that is super important for you to always remember. Okay. This is this is how I feel about spreads. And everybody's different, dude. Some people make spreads work for them, but
Yeah.
when you sell a call credit spread, you hope that the share price stays the same or goes down, and that's how you realize the equity. And the thing about spreads, right, is they have a high ROI. Like you can do 35-40% ROI in spreads, which makes them
Yeah.
attractive and lucrative.
Right.
The problem is this little word right here, right?
Yeah.
The stock market
Yeah.
doesn't care about your health, and it will shoot
Right.
up, it will shoot down. It does not care. The same thing is true of put credit spreads. You know, you hope that it
Right.
stays the same or goes up, right? But again, we're playing the hope game. And when you sell a covered call, you're not in the hope game. You're in the income game. And dude, you're already in this
Right.
game. I would literally, I mean, unless I can show you a way that spreads would make sense for you, but it has to be at a very specific ratio. And I just don't know that the juice is worth the squeeze, to be honest with you.
Right.
Like
Right.
I saw, for instance, like you have, let's take this example right here. So if you have 900 shares of this forever stock and you're selling 9 contracts on a weekly basis, like I would consider selling like one spread in the opposite direction of this position. And the reason I say one is because you're getting paid for this position, right? Like you're getting paid to sell this. You got paid 468 times 9, right?
No. 468 is for all 9.
Say what?
So the 468 is the total. So that's for the 900 shares. Yeah.
Oh, okay. So this is how much premium. That's why you're saying like get out of it.
Yeah.
Okay. So what I was gonna say is, if I had a big position and I was selling covered calls against it, I would only consider using a piece of my premium in the covered call position, like in a spread position. In other words, like if I already had a covered call, I'm already making money on the upside. So I would want to find the Bollinger Band and maybe do a very small credit spread on the downside that is the opposite of that position. But I mean, again, like you're playing in the hope game and you're hanging collateral on hope. And then something like Friday happens where the market just crow, and you're like how do you feel emotionally when you see that stuff?
I mean, I lost money, which is why I'm now being really cautious. That's exactly what happened. I placed a spread, I lost money. So
I'm averse to losing money personally.
Yeah.
I don't like it. When you sell a covered call, how do you lose money?
I've never lost money, which is a good thing.
Exactly my point. There's no hope associated.
Even the puts, right? They're safe. Yeah, spreads. I guess I was just more interested. Like, with a vertical call spread, right, on the shares, you could still only get up to 9, right, in this case. So it would just be better to just do a normal call.
Yeah, I think so.
Yeah. Okay. I think that was the bit that was confusing me
Yeah.
because the difference, it wouldn't even make sense.
Yeah,
Okay.
and stay out of spreads. I think generally speaking,
Yeah.
I think when you're playing this game, and trust me, this is a game, right?
Yeah.
Like you get a turn,
Yeah.
you are deciding to take a turn every week. I go a little bit
Yeah.
longer than that in my turn range. I go for like 3 weeks out. But I used to think like you because I wanted to see the weekly, right? But now I think like I have other stuff to do and I kind of want data to work for me. So I do 3 weeks out. And I do sense there's a difference in the premium received, but I also sense there's a difference in like how much I look at it, right? And how it affects me when there's changes in the market. Like since I've started trading this way, like I have no emotional connection to the market anymore. I just look at when is the next buying opportunity and who in my garden is getting an additional positions. You should always be adding to positions.
Yeah, I think in my case, because I'm literally doing the same trades every week, I spend less than 5 minutes just doing them because it's just the same thing, right? Buy covered calls for
exactly.
Palantir, Tesla, Google, and then
right.
Any capital left over, just look at Henry's trades, what he recommends, and allocate accordingly. That's literally like so less than 15 minutes a week.
Super easy.
So that's
yeah.
So for me, then I don't even log on till Friday, and then I go, okay, where are we? And then so I actually used to do monthly. So like I was saying, but what I found was like, well, I'm logging on anyway, like checking anyway.
Yeah.
So I may as well just
No, for sure.
And I think mentally, I'm like, once my portfolio is at a certain amount, I'm pretty sure I'll move back to monthly, right? Because the 1% or 2% will be enough, right? But at the moment, I'm kind of in this mid weird range where it's like it's not quite enough, but it's not low enough to not care, right? So I kind of like I'm trying to strike that one. Honestly, I think in like 3-4 months, I'll probably move back to even bi-weekly or monthly. So I think the time horizon is definitely not fixed for me.
Let me ask you a question. When you buy something, are you looking at your ROI on your transactions when you go to sell?
Yeah.
Okay. So what ROI are you targeting on transactions when you buy something?
Minus Google, because it's always like 1%, right? Because I can't do anything.
Sure.
At least 2.5, 3.
Okay. Yeah. Okay. So the only difference, I guess, then between us is that by going for a slightly longer time horizon, I'm targeting a 10% ROI. So I mean, but it's the same thing if you're talking weekly and you're going to hit 3 weeks, doing 3.3% in 3 weeks. It's 10%. It's the same exact. So I mean, like, I just like to set it and forget it though. So I do 3 weeks.
I mean, honestly, if we can get to also maybe we can actually discuss this so this may be a bit off topic on the leaks, but what I do is when Henry posts his trades on Henry Trades, I copy paste them into an Excel. I check the premiums, and he usually has monthly or longer, right? So I do the calculation on there.
He's the one that got me to transition to monthly versus weekly.
Yeah. But none of those are 10%. Right? All of those premiums come to 1%, 2%, 3%. So that's kind of why I moved to weekly, because I was like, well, I'm not going to ever hit even 5. Honestly, if I can get 10% on my portfolio a month, I would be happy to trade monthly. But I'm not getting 10% unless I go weekly.
Oh, okay. Well, listen, I mean, all you have to do is look at the math to get the 10%. I think Henry's trades more look at the delta, right? And and really delta is like probability of success. Like if you're shooting at that like high 85-90% probability of success every time, like you're just not going to have a lot of turbulence, right? Like there might be some fluctuation in your underlying assets, but you're going to get to next week and the transaction should be easy to you. But for me personally, I mean, dude, the only thing I look at is premium received versus cost. And I look at this is the only equation I use, and it has to equal 10%. So if I can look at my costs and I'm spending $10,000 on something, I will only do it when I get $1,000 premium received. Like it's super easy when you look at the equation and this formulation, because then remember, you've never lost money selling covered calls, and you can roll whenever you want. You select the price, select the expiration. You are in total control of this like strategy. The only thing that you don't have any control is, the underlying asset can shift in its valuations, right? And if it goes down, it expires worthless, you sell it again. If it stays the same, it expires worthless and you sell it again. And if it goes up too much, you have to roll out. I mean, dude, every single one of those is in your favor. So that's why you don't lose money selling covered calls, because you are paid today for something that may or may not happen.
But the thing is aren't you you may make the 10%, but then you may be waiting 6 more months.
So I will say this. When I look at the transaction, I look at it in these terms, like this has to be for my first transaction.
Yeah.
Right. And I recognize that when I spend money, my goal is to do this transaction multiple times. Right. Like that is how you make money in the stock market. Now, only two things keep you from being able to execute the same number of transactions, depending on the time that you bought, right? Because you're buying this thing that has a time value associated with it. For instance, if I bought a leap and it was to September, I know that that's 7 months away. 7 times 4 is about 28 weeks. And if I'm doing these on 3-week increments, that's just right at like 9 transactions that I could do. Right.
Yeah.
And if I'm making 10% back per transaction, that means that at least 90% of my capital allocation should be able to exit that trade in that time frame.
Right.
But when am I not able to hit 9 transactions is when the share price goes up too much, right?
Yeah.
So when the share price goes up too much and I have to roll out, that means the underlying position has retained a lot of intrinsic value.
Yeah.
Okay, so look at this, right? Let's say.
Oh, right, because the actual stock would have gone up. Yeah, correct.
Yes. Let's say this. Let's say you paid $5,000 for a leap, right? And let's say your leap, that leap we targeted will then generate you $500 of premium in the first transaction. That means your cost in that is now $4,500. Say we're talking about $100 strike.
Yeah.
You know how to calculate your break even?
Yeah.
What is your break even on this transaction we're talking about?
So with the strike, so we 100 plus total cost, which is 5,000 divided by contracts. Is this for one contract?
One contract, yeah.
So we 101.
What is it?
101.
No. So remember, your cost divided by 100 shares, right? So this is going to give you a $50 valuation. So it's always going to be your cost plus your strike is your break even. But remember, you already received $500 for that. So your new break even went down to 45. So your new break even becomes 145, right? Now, what that means is the share price of the underlying asset has to be at 145 for you to retain your entire value of your position, the intrinsic value. Okay. So let me ask you another question. How does your money double in this position? When does your money get to double?
when you've collected enough premium, right? So the break even is 0.
Let's not consider the premium received. Let's just consider the share price. Like when the share price gets to what does your money
go? When the share price depends on your delta, right? So a 0.7
doesn't depend on delta at all. Like you have all the information on the screen right now, and this is like the power of leads. Like that, I think that like a lot of people don't see this, but like remember, now this is the first transaction, so your break even is $45, right?
Yeah.
Your break even would now be $45. So to double your money, the share price needs to get to 190. Does that make sense? Like for your Google example up here, and this is the difference between shares, right? For your Google example here, you have 900 shares, and let's say your average cost basis is 135. For your valuation here to double, this would have to go to 270.
Right.
Right? Yeah. But that's not the case here. For your money to double, remember, you've put $5,000 into this. And then you got paid $500. So now you only have $4,500 into it. And what you want to see, you want to see $4,500 double, right? In order for you to see $4,500 double, the share price has to get to 190. Does that make sense?
It needs to get to 190 from 100.
From 100 because 100 is your strike.
Oh, okay.
Own it at. Yeah. Sorry.
Okay, got it. Yeah.
Yeah, exactly.
Yeah.
So this is the power of leaps, right? So what you want to have happen is there is high intrinsic value in your leap at expiration. Because then what happens is you get this big bag of gold every time the rainbow ends. Right? I see these guys in the Discord and they're selling their leaps out in profits when there's still like 7 months left. And it makes me sick to my stomach. And I'm like, why would you give away a golden goose? Because if you have that leap with a great strike price, I mean, you should be able to print premium all the way to the end. And remember, every time you print premium, your break even goes down. You are trying to eliminate 10% of your cost in the first transaction. Right? And you're trying to do as many transactions as possible. And the only thing that would preclude you from doing your original transaction formulation is the share price went too fast on you and you had to roll it. And so like, I would rather have a big bag of gold in September, right? Yeah. And have sold premium against it occasionally because I had to roll it out so far. But that's a lot of equity. So then, in September, I get all that equity back and I start this whole transaction process again. This is super important that you remember how break even impacts like the valuation of your asset. Because as your break even lowers, you get to the double number faster. This number becomes less and less to you to double your money.
So can you go to the test leap example? I think it helps cement things in. And I can then, and let's use your 10% rule, because I think this is maybe what I'm missing. So Tesla, I can actually give you the real numbers. I didn't post real numbers on Discord. So I actually have 15 contracts. Sorry, 1 second, let me check. Yeah, 15 contracts. Which I spent 155,000 on.
Let's talk about it in a specific way though. You have 15 contracts. What's your strike?
350. September expiration.
Man, you're going too fast for me.
Yeah, strike 350. September expiration.
what is it, September 19th?
Yeah.
So super important that you think of your positions in this way, September 19th. Okay. And don't tell me how much they all cost. I don't care. Tell me how much one cost. There, it should say average cost or something to that effect.
Let me check.
The way mine says it, it says, yeah, mine literally says average cost.
Mine just says, I'm on Charles Schwab, it just says price change, market value, cost basis,
Cost
gain
basis.
loss. Oh, cost basis 155,000.
Like that.
2 more zeros.
Oh, that's the total position.
That's what's under cost basis. Maybe that's the.
Okay, so they cost you about 10,000 each.
Yeah.
Okay. Well, there you go. That's the example I just gave you. If something costs you $10,000, you better be able to get $1,000 in the first transaction. Okay, so
I think I did. So if I look at the premium, so if I I'm just on call, sell to open, and I'm just going to go for next week, right, on Friday. The three. So basically, we're looking for 10,000, right? Because
no,
sorry,
you'd be looking
how
at
much?
15,000. I'd be trying to target 15,000.
So 15,000.
But I can already tell where you're going to get in trouble. Go ahead.
Yeah, so that's like that's like a strike that's lower than the current stock price. Yeah.
So remember, you're at 350 for your strike, which means you can buy Tesla at 350. You want to target above that. Actually, these are going to cost what?
Yeah. Maybe we should use Palantir because Tesla is currently lower, right, than 350.
No. That's why. This is a perfect example. This is a perfect example. Tell me what you sold a covered call
at. Let me look at my Excel. The first one.
Because I assume you have a covered call for this week, right?
I do.
What strike did you select for your covered call?
But I did a 2-week covered call, so I didn't have one for last Friday. So I think I got 1 second.
Let's do strike price first.
Yeah, just opening it 1 second. Strike 365.
Right. What did you get for that?
Almost 9,000.
90,000?
9,000.
9,000. Okay. Let me see.
And I'm like, I was actually going to exit.
Tell me the exact number that you got. Tell me the exact number you got.
8914.
8914 divided by 15. You got paid 594 per. Okay.
And in the first call, like ever, for this, I made about 1,500
per
total. Because I picked a really safe delta. This is last year. That was my first call on this.
Let's pretend like this was your first. Okay.
Yeah.
Just because I can only deal with like what's today, and you can kind of take forward the rest of this information tomorrow.
Yeah.
So again, remember this is per share.
Yeah.
So your cost per share divided by 100, which brings you down to remember This is per. So you have a new cost basis. It's gonna be 101 minus, let's call it 6, okay? Just to be easy on me.
Yeah. Yeah.
And that's gonna be bring your cost basis to $95. Okay.
Yeah.
And your strike that you own is at 350. So strike is 350 plus $95. This is your break even, okay? Your break even is going to be 445. Is that right?
Yeah.
My math right on that? That's just in my head. Okay, so this means at expiration in September, Tesla's share price has to be 445 for you to recoup the $10,100 that you spent on all these.
Yep.
Okay, so I'm gonna look at an example in the option chain because I kind of want to show you what you did versus maybe what you should do. You're selling an extremely tight strike here, and I get that it's for this week, but you know you're giving up very little intrinsic or extrinsic value, but you're giving up a ton of your intrinsic value to sell a 365 call option against you're nowhere near your break even. Okay.
Right.
So like I would consider this almost a mistake. So if I was looking at this trade and I wanted to be a profitable trader, I would consider like a March 21st, and you know, be fair here because we're not trading with the market open and option prices are probably different than what we're looking at right now. But I would probably go to like
sorry, just to on Monday when I placed the trade, the stock was at 356. It's now 331. Yeah.
Oh, Tesla's at 3. Yeah, I see at 337, right?
Yeah. So it massively dropped on Friday, right, to 335. Sorry. But yeah, on Monday it was like 355.
Yeah, Tesla. I mean, Tesla is super volatile. It's always been like that, right?
Yeah.
I will tell you, every time I've gotten in trouble with Tesla, it's because I sold a covered call and then it skyrockets past my covered call.
Yeah.
That's literally, I've never lost money in Tesla. Like Elon Musk has saved my my trading portfolio multiple times. But every time
like, what happens if it's like, for example, say I'm just looking at the chart, right? So it was say 355, and I don't know, you sell a covered call for 360. Now on Feb 19th, it went to 363, right? And pretend it stayed there. So you would roll your covered call out and get a credit and go for a higher strike, right?
Yeah, I mean, to be honest with you, I wouldn't sell if I owned a leap at a 350 strike. It would take desperate times for me to sell a covered call at 365. I would rather give up more extrinsic value. I'd rather give up more time value for more capital.
Right.
And what that means is like I would go out a little further and I would sell a higher strike than you. If this trade closed right now, if this 365 trade closed, you know how much you would get paid?
No.
You should know this. This is really
important. If it expires?
No. Let's say you got assigned on this.
Yeah, I would have to close the leap because that would be 15 times 100 shares, right? At the 350.
Yeah. You'd get $1,500 for this position.
Yeah.
You get $1,500 for a position you paid $10,000.
Yeah.
It's saying like you don't really want to sell a strike here.
Right.
Like, and I recognize that, yeah, you could roll it. I get that, but you don't really want to be at this position.
Okay.
I would consider more extrinsic value in your sale for a higher strike. Like you know your break even's like 400. What did we say? I thought we wrote about your break even.
Oh yeah,
445. I mean, you probably want to be selling somewhere in the fours, and that might mean you have to go out further in time. Like I'm in April 380 is 1,000. April 17th. April 17th, if you do a 390 is 1,100. And that kind of gets you at that 10%. 395 is 1,000. So, when you consider these, remember that you do have $10,000 in this position in one of these, and you want to make sure that you're able to get the strike that you're selling as close to your break even by expiration or higher, right? Like that's how you make money.
Yeah.
And the way to mitigate losses in the position is by receiving premium, but you don't necessarily want to get premium at such a tight strike, because let's say we show up on Monday and this happens, and if you haven't seen it yet, it'll come for you. Say we show up on Monday morning and we wake up and Tesla's at like 380. You're going to have to roll this position out into the future. You're going to have to roll this position out into the future. And you're not going to be able to move that strike a ton, right? You're going to be able to move that strike maybe $25 or $30. And then you get it up to 390 and you're in that same position. You're still selling below your strike. You're still selling below your break even to receive a premium, unless you want to break the unholy written rule and, buy the position back, which, we don't like to spend more money than we already spent. We already spent money on this position, so we don't want to spend more. Yeah. So it is a word of caution that this is a dangerous strike, and it is to play that weekly premium game. And I understand it, but you do have to disconnect when you look at your break even is so high. Okay. You have $10,000 in this position.
Yeah. How did you figure out what's like, if you go for monthly, right? Instead, how did you figure out the strike?
I literally, I look at what my cost is, right? I look at what my $10,000 is going out to, and I find the position that pays me this back in the 10% increment. So like, if I would have to build a trade to show you, and for me, like now that Tesla is at this new price, I would probably consider buying like a 300 call, right? A 300 strike September is still quite a ways out. So I would consider buying, let me see what the pricing is, right? Just since we're talking about this, since we're talking about this particular ticker symbol. So buy a call, I would go and look at the 300, and right now the 300 is at, I'll pull this down here a little bit further and we'll talk about this example. Like if I had cash today, which I'm going to have cash tomorrow because I had an expiration on Friday and got paid in, I would look at this 300 strike, right? Price right now is 7,800. So that means when I go to sell a covered call on this position that I would just be buying, I would need to make at least $780 on the position I selected with the strike I want. But just to keep everything kosher, let's say this was cost. These notes. Say this was cost. What's our break even?
300 plus 70, 378.
That's right. That's our break even, right? So now that I bought this thing and I'm holding it, I would like, I would like to make some premium on it. I start at the 3-week mark. 1, 2, 3. So I would be starting looking at March 21st because I always skip the week I'm in, right? Like we're in the week. That week doesn't count. And I go to sell covered call. And I could go. I mean, I could go all the way up to 370. I could sell a covered call at 370 for March 21st, and that premium received would be 785. So that's actually over the 10% that I'm looking for in the first transaction. And now you see where I'm selling. I'm selling the 370, and my break even is at 378. And I have a ton of extrinsic value left in this contract. Like there is almost no risk to me in this contract. Like even if this somehow got assigned, I mean, I'd still be making $7,000 on this position, but I'd be making 7,000 plus 785. I'm like $15 away from being completely out of this position, right? So like that's like when you look at these, I mean, like you really should look at them more in that way. Now there are some absolute there are some examples where you can sell much closer to your strike, especially if you're in the 5th and 6th and 7th transactions, because then most of your money's already out of the position. But if you're in the 1st and 2nd transaction, like you should actually be looking to target a new strike and expiration.
But in this example, right, like you're paying 700-800, you're basically making the 800-ish back, right, within the first month. So you still have 7,000, right, to recoup.
Yeah, but remember, that money is being paid to you, but that doesn't necessarily mean the position has been devalued. Right? Like you got paid that 800, 785, but that doesn't mean the Tesla continues to drop. Like we have no idea what it's going to do by your next expiration. We'd have no idea what it's going to do by March 21st. Right? Like the goal of this transaction is just to make any losses mitigated. But with your $62,000 example.
I'm still confused how you've made 50% back. Like you've made 800 back, 50%. Right? Which is 10%.
No. I said if you do this 5 or 6 times, if you do the same transaction.
Oh,
you've done it March, April, May, June, July. Like let's say by July, right? You're on transaction number 5. Then I mean, realistically, you probably made more than 50% back because with $785, I don't keep the cash. This goes to buying something else, and especially if you're doing it, at volume. So like if you exited Google and you had that 162,000 and you bought this specific example, you buy 20 of these. So times 20. 20, that would come out to 15,700. And remember, it's 10%, right? Like 7,800 and you're getting back 7,850. I mean, like, that's more than 10% there. And, again, every time you have money, once you execute this position, you've spent money, but now you have money, right? If you did this 10 times, you'd have $7,800. That would literally buy itself another deposit by itself.
Yeah. Okay.
And the goal is over time, like you're doing, kind of. You start with 15 positions and 30, and you 50. But you're selling. So volume is king.
Got it. Yeah, it may make sense. Okay, that makes a lot more sense. So I think what I'll do is I'll look at my Excel, just do the math on how much money I made so far, and how far I am right in the cost basis, and then start doing monthly and make sure. Because September, right? So I think I brought the contract December, if I remember correctly. So halfway would be May, right? So we want to be at least 50% by then.
Yeah, and I mean, the other thing is there's two schools of thought, especially with the contract sizing that you have for sales. I mean, you want to be adding to your current positions, like your September position. You would want to maybe even press those positions. And then you'd also want to be putting money into the future. So like for instance, right? Like, let's say you have, what was this one? You have a 350 strike on Tesla. I mean, like, the next thing to do, like, especially at today's current prices, would be to buy like an even better strike, right? And you spent 10,100 on your 350 strike. This $300 strike now cost you 7,800. Like, when you have capital, capital comes in and it goes to the next best position, and that not necessarily align with today's position, but it could align with, like, today's income strategy. And like, really, this game is an income game.
Right.
People think it's a Tesla or Google or Palantir game, but it has nothing to do with those. Those are just numbers that provide you this data, right? And this is the data.
Yeah. So to dollar cost, I think this is, I guess, the topic we were going to discuss is the dollar cost averaging on a leap doesn't necessarily need to be the same strike and expiry, right? You can do others, but it'll still average so long as it's the same stock. Because the calls I then buy, right, will be on, like, say if I bought two of these, 300, 700, 800, right, which would add to my Tesla position. Now I have 15, 16, 17, right, in total. So I would do the calls on the full 17.
Yeah, exactly.
Yeah.
I mean, I would even consider, you absolutely could keep all your covered calls that you're selling. You could actually keep all those strikes the same, because remember, you have different bookmarks in time with those different leaps, strikes, and expirations. So but just the break-even game is super important.
Okay, no, that's helpful. Yeah, I didn't think of it this way, but it makes sense.
Cool, man. Well, listen, if you have any other questions, let me know. I know we've been on for a little while here, but I'm gonna hit the